All right, welcome to this week's episode of DoubleLine Minutes. I'm Jeff Mayberry, back with Sam Lau.
Hey, hey.
It's 10 a.m., 10:04 Pacific time. Let's be precise here on August 16th. Just reminded that soccer season starts again. The EPL kicks off in under 2 hours, and I'm excited for it.
Yeah, you kind of got me excited when you mentioned the World Cup the other day. I'm not sure if it's actually time or not, but I love that World Cup action.
You do, and it's not until 2026 in the U.S. and Mexico and Canada.
All right, we're getting close.
All right, well let's get into where are we for the week.
All right, looks like a pretty good week across the board here as we stand here on Friday morning. Right now, the S&P 500 is up about 30 basis points or so on the day. It's up a whopping 4% on the week to date so far, really being driven by a rebound in the technology and discretionary sectors. Week to date, technology is up almost 8%. Consumer discretionary is up about 5.5%. And everything, for the most part, is in the green, with the exception of real estate, which had been a past leader, a weekly leader on performance basis for the last few weeks. Now it's the laggard, down 20 basis points at this point for the week to date. Its counterpart in that is utilities. Utilities is up a percent, but it is also one of those oddballs that was making its appearance as one of the leaders for the S&P 500 sectors for the week. Utilities and real estate a little bit tend not to hear that too much in terms of being the winners. But when I take a look at it here, utilities is still the best performing sector, competing for first place with comm services up both up over 19% on the year-to-date basis. So it'll be interesting to see how the rest of the year shakes out, as always there. But looking at it, this 4% week on the S&P 500 has pushed the S&P 500 back up into positive territory for the month to date through August 16th here. I see it's up almost a percent now for the month to date, recovering some of the loss, or all the losses that we saw from that first week in August when the S&P was down pretty significantly on those days. Now, looking across the board here into fixed income land, the 2-year Treasury note is at 407. That is 2 basis points higher in the yield. I did notice that the 2-year had dipped below 4% again at some point this week for a few days, but the recent data points that we had in eco land, in macro land, kind of pushed it back up above 4. So I'll leave that part for you, maybe when you get to the macro. But it did look like the 10-year kind of had that same pattern as well, as it tested that resistance level around 3.8 for a spell on an intraday basis, but we couldn't quite break through again. But that resistance level is one that's took place, I believe it was August 5th, that Monday following payroll Fridays, where the markets went a little haywire across both equities and fixed income. It tested 3.8 at that point, as well as December back in 2023. So we'll see if that continues to hold. But there's a lot of space below if it does break through that 3.8. It looks like it might be on the chart here. It looks like it might be kind of a 350 10 years, the next kind of key point if it does drop below that 3.8 that we've been holding. But that's right now at 3.89 as of time recording. That's 5 basis points lower in yield there where it ended the week last Friday. Similar type story that we see in the bond here with the 3rd-year Treasury is at a yield of 4.15. That's 7 basis points lower than it was the previous Friday. But on a year-to-date basis, looks like the 2-year note is at 20 basis points lower in yield. So quite a bit of a rally there on the front end of the curve, reflection of how markets are thinking about the next Fed rate policy move there. So we'll continue to watch that as always. But what all this meant for the broader bond market, the Bloomberg U.S. bond aggregate is up about 0.5 point on a week-to-date basis. Year-to-date, it's up almost 3%. And then taking a look at it here on the week-to-date basis, it's been driven by the IG corporate credit sector. That's up about 1.25% on the week-to-date, followed closely by EM sovereign debt up 1.2. And then you've got high yield up at 1%. it's kind of a weird cohort and mix of characters, cast of characters there, because you have on the other end, the other three sectors are still positive. The traditional sectors of the Bloomberg aggregate, with MBS and Treasuries up about 40 basis points, and then bank loans up about 40 basis points as well. But you have those three real leaders there, with the IG corporate credit and high yield and EM sovereign debt up over 1%. Making our way over to commodity land, commodity has a positive performance on the week-to-date basis, up about 40 basis points, similar to its year-to-date. So it's just really hanging in there for the year-to-date and each on a week-to-week basis. But I take a look at the WTI front-month crude futures. That's at a dollar price of $76.50 per barrel of WTI crude. That's down about 40 basis points on the week when looking at that price return, still holding on to the 7% positive return for the year. Gold doesn't look like it was able to break the 2,500 mark on the front month futures contract, at least. Right now it's at 2,488. I saw it got up to 2,490 something and some change there earlier today, but getting close to that 2,500 mark. We'll see if it gets there next week as we get through some of the Fedspeak with the Jerome Powell set to speak next week as well. But on a week-to-date basis, gold is up 2.5%. 20% on the year-to-date basis. So with that roundup of markets, Jeff, do you want to kick us off on the macro front?
Yeah, thanks, Sam. It was inflation week, as Mark and I talked about last Friday. So on Tuesday, we did get the PPI. The final demand PPI month over month was a positive 0.1%. That's slightly below the 0.2% estimate. If you took out food and energy, it came in flat. It was expected to be up 0.2%. So good all around there from a producer prices front. That brought the year over year to 2.2 and 2.4 ex food and energy. So slightly below expectations there. And really looking at it, this is the first negative print we've seen in the services so far this year. There were 3 negative prints last year. This is in the services basket of the PPI. So, even though we started off pretty hot in terms of PPI, we've kind of settled in here. And then to round out inflation week, we did get the CPI numbers on Wednesday. The CPI month over month was a 0.2, right on expectations. The ex food and energy was also a 0.2, right on expectations. But that was on the round. So if you kind of look at the numbers and go through the year over year, the CPI came in at 2.9, was expected to be 3.0, and is the lowest print since March of 2021. The first time we've had a 2 handle here on CPI since, I guess we did see a 2023 low of 3.0. So it's the first time we were at a 2.9 or 2 handle in over a year and a half. And that brought the ex food and energy was flat though at 3.2. So that's really taken a little bit of time to get back down. But really the CPI was nothing to worry about, and really kind of charged the markets. Fed rate cuts were being more pressed into the market. I think we were down to over like a 60% chance of a 50 basis point Fed rate cut in September. The 10-year closed at 384, but it was down to about that 380 level, resistance level intraday, Sam, as you mentioned, on Wednesday. And both Tuesday and Wednesday, you did see the 2-year below 4%, even though it bounced up. And the reason it bounced back up was the retail sales numbers, or I guess one of the reasons that it bounced up is the retail sales numbers that we did get on Thursday. We got a very strong month over month headline retail sales number of 1%. It was expected to be a 0.4. So a big, I guess a big miss, but a positive miss there on the retail sales side. It was revised down. The last number was revised down slightly, but not as large as the miss. So positive on that front. There was some talk about a lot of it was in the motor vehicles or autos side of things because of that cyber attack that limited sales in June. So you got a bit of a rebound there. But that's why we also like to look at the ex-autos and gas retail sales numbers. That was up 0.4, was expected to be a 0.2. So another big beat there from the ex-autos and gas. And then the part that goes into the GDP, the so-called control group on retail sales, was a positive 0.3, was expected to be 0.1. So a beat there. So all across the board, retail sales beat expectations. And really that caused the market to say, well, maybe the economy is not falling apart. Kind of similar to when we got the ISM services numbers last week. Maybe things aren't as bad as that non-farm payroll number was really showing. Really, so we kind of dialed back the Fed rate expectations a little bit. I'll talk about the warp here in a second. But really, it kind of gave the market pause, and maybe the Fed's not going to be aggressively cutting rates as fast as they were hoping. We did get the jobless claims also on Thursday. Yes. We got jobless claims.
No, I was just going to say, really, just a tale of two markets there again that we're seeing. With the bond market selling off a little bit on that good news is bad news kind of a thing for the Fed monetary policy. But then you had the S&P 500 just really have one of its strongest days for the week. It was up over 1.6% on the news for the retail sales. So the good news is good news because the economy's not as weak as had been expected, at least based on that one retail sales report. So
you're in a place now where it's almost for the stock market, it's almost the best case scenario, the Goldilocks scenario, where the economy is still strong, but not so strong. The Fed is worried about inflation and is going to raise rates or continue to keep rates at this level. They're still planning to cut. So you get the both sides of things, the best sides where you get a rate cut and a decent economy. So that's helpful for the stock market.
Absolutely.
We did get jobless claims also on Thursday. They came in below expectations. Came in at 220. The initial claims came in at 227,000. Expected to be 235. So a slightly better number there. Continuing claims at 1.864 million versus 1.887 expectation. So again, continuing to move down. The 4-week moving average of continuing claims actually increased, but very, very slightly. And it's the 4-week moving average of the initial claims decreased actually. So kind of a mixed bag there. You've seen a lot of talk about the initial claims in Texas from the hurricane really being the effect, and you saw claims drop pretty precipitously there in Texas over the past couple of weeks. So that kind of bears itself out. We also got import prices on Thursday. Import price month over month came in at 0.1. It was expected to fall. So a little bit stronger there. Ex-petroleum was the 0.2, expected to be 0.1 there. That puts the year-over-year number at 1.6. So it's kind of a tame numbers there, nothing really to worry about there. And then actually this morning we got, we don't really like the sentiment indices, the surveys, but one thing we do look at because, Chair Powell has mentioned in the past that he does look at the long-term inflation expectations. So the University of Michigan inflation expectations, 5 to 10-year inflation expectations came in at 3.0. That was expected to fall to 2.9, but 3.0 is in line with where they were last month. So nothing to get worried about there. Inflation has not become unanchored again like it was before in the past. And so nothing to worry about from that side of things. If we do shift over to WIRP, we do have a 26% chance. Oh, let me just check. Update, a 30% chance of a 50 basis point cut on September 18th. That's down from 54% last week. Pricing in 3 3.75 cuts in 2024 was a solid four cuts. So 100 basis point in cuts in 2024. So we're anywhere from 75 to 100 basis points in 2024. And the Fed announced their meeting dates. And so now we can look further out on the curve. And the market is pricing in 2% rate cuts between now and the end of 2025. So over the next few months or next 16 months or so, 8 rate cuts or 2%. Sam, did you want to talk about Fedspeak? I didn't think there's too much out there that really moved markets from the Fedspeak side of things.
Yeah, it didn't seem like too much was going on. We did get Bostic coming out and just, he tends to lean or has tended to lean a little bit hawkish in the most recent part of the cycle, but he did indicate that he was kind of on board with the idea that the Fed could start easing the policy rate a little bit, and it's getting important to not to be too late in that move. What was interesting to me is the first time I heard this name, and I think this is the first time I actually heard saw it in print, but one of the FOMC or one of the Federal Reserve Bank presidents, Muslim, came out and also made a similar type statement where he's also, I guess, had a tendency to lean hawkish and also expressed a more slightly dovish view in saying that it'd be appropriate to start adjusting rates. But it was interesting. I had to look up Muslim, and apparently he was just became the president of the St. Louis Fed back in January to replace Charlie Bullard. So I expect that we'll start to see his name more in the future. Right now, he's a non-voting member. He's an alternate member, but 2025, I believe, is when he's expected to rotate in, if I remember correctly there. So something to watch there, I suppose.
Yep. And with that, as something to watch, let's go to things to keep an eye on for next week. It is a quiet week. We do get on Monday the leading index. That number is expected to be a negative 0.3 print. A negative 0.2 was last month, but we have a negative 0.3 rolling off. So LEI should be flat there at a negative 4.8. We do get on Wednesday the FOMC meeting minutes. It doesn't really seem like we'll get anything outside of, nothing earth-shattering there. Powell was pretty clear in the press conference that they're looking at rate cuts in September, so I don't expect the meeting minutes to do much. Thursday, we get jobless claims, as always, and a little early to get estimates out. Yeah, but we expect them to kind of stay steady as she drifts there. And then we get the S&P Global Manufacturing and Services PMI numbers. These are the August preliminary numbers. Last month, the manufacturing was below 50 at 49.6, but services was at 55.0. So we'll have to see whether those shake out. And then the big piece of news, or the big market moving event, let's say, is Powell speaks on the economic outlook. That is on Friday at 7 a.m. Pacific time. That's the Jackson Hole speech. I would expect that he would likely take over the 8 minutes that he did in the There Will Be Pain speech. But it'll be interesting to see what he says and kind of how that sets up for future Fed rate policy.
Yeah, it will be interesting to see what type of tone he sets, but I don't expect it to be too much different from what he just presented back in July. But that's the last time we really hear from him until, I suppose, until the September 18th FOMC meeting. But really between that Jackson Hole and that September FOMC meeting, where you also get the summary of economic projections, we're going to have the CPI data come out, and then also one more payroll and jobs data report coming out. So I think that's the one that people need to watch for to see if it really moves the needle between Jackson Hole and the September FOMC meeting, as we started to see perhaps a little bit of a shifting of gears in the labor market in the most recent prints.
Yeah, I think that's right. I think the payroll, if it maybe it rebounds and that last month was just an aberration, or if it confirms the still growing but declining payroll number, then I think that the Fed will become a little bit more worried. But we'll have to see. You're right. It'll become Powell comes before that, so I would not expect too much from it. But you never know with Jay. He could be setting things up.
Yep. So I guess that pretty much wraps it up for this week, Jeff. I just wanted to thank everyone out there for checking us out here at DoubleLine Minutes, either on the X or on your favorite podcast platform. Don't forget, you can send us an email, or you can hit us up on the X DLine Minutes if you have any questions, comments, or suggestions.
Don't forget our website is doubleline.com. YouTube channel is youtube.com/DoubleLine Capital. And we are those of you, if you missed a nugget of wisdom or came in late to the spaces, we are posting the audio there on our YouTube channel there, so you can check that out. Also, we do have a new blog post going up on office occupancy. And then on our YouTube, we also have Jeff Sherman on the UBS Market Moves podcast, and then a very short clip from him on the BBC from earlier this week. So make sure to check those out. And I'd like to thank everyone for tuning in and hope everyone has a great weekend.
Yeah, thanks everyone, and good luck out there.